Ladies and gentlemen, stop what you're doing. Something just shifted in the Middle East, and the market's reaction tells you everything. The headlines talk about diplomacy, sanctions, military posture. But that's not the real story. The real story is what's happening in the oil market right now, what's moving through the Treasury system, what central banks are doing in silence while everyone watches the news. Let me walk you through what just happened. Tensions between the United States and Iran escalated again. You've seen this before. Threats, counter-threats, naval movements, Strait of Hormuz concerns, the usual theater. Except this time, something broke. The oil futures market didn't just react, it convulsed. Brent crude spiked 7% in 48 hours. That's not normal volatility. That's not speculative positioning. That's panic buying. That's someone pricing in a supply shock that hasn't happened yet. And here's where it gets interesting. The spike didn't come from reduced supply. Iran is still exporting. The strait is still open. Tankers are still moving. So why did the price move like the oil stopped flowing? Because the market isn't reacting to what happened. It's reacting to what it knows is coming. It's pricing in the war before the war starts. Now look at what happened next. U.S. Treasury yields jumped. Not gradually, not in a smooth curve. They gapped up. The 10-year moved 15 basis points overnight. That's a violent move. That's a fear move. And it tells you that someone just dumped a massive position. Someone needed dollars. Someone needed liquidity. And they needed it immediately. You want to know who? Look at the foreign holder data. Look at which central banks have been quietly reducing their treasury positions over the past 6 months. China, Saudi Arabia, UAE, Japan in smaller increments. They've been rotating out of dollar-denominated assets and into what? Gold, oil reserves, yuan-denominated instruments. They've been preparing for this exact scenario. They knew the collision was coming. Let me show you what this really means. When tensions rise in the Middle East, the first assumption is simple. Oil goes up, defense stocks go up, safe havens get a bid. That's the surface read. But underneath, there's a structural shift happening that most people aren't seeing. This isn't just about oil supply risk. This is about the entire petrodollar architecture starting to crack under pressure. Here's the mechanism. For 50 years, the deal was simple. Middle Eastern oil gets sold in dollars. Those dollars get recycled into U.S. treasuries. That system keeps the dollar dominant. It keeps American debt affordable. It keeps the whole empire running. But what happens when the Middle East starts questioning that arrangement? What happens when Saudi Arabia starts pricing oil in yuan for Chinese buyers? What happens when Iran, already locked out of the dollar system, builds alternative payment rails with Russia, China, and India? You get exactly what we're seeing right now. A market that's pricing in not just a military conflict, but a monetary realignment. The oil spike isn't just about barrels, it's about the currency those barrels are traded in. It's about what happens when the Gulf states start to hedge their dollar exposure, because they're not sure Washington can guarantee their security anymore. And here's the part that should terrify you. The Federal Reserve just spent 2 years trying to cool inflation. They hiked rates, they drained liquidity, they crushed demand. And just when inflation started to ease, just when the data started to cooperate, geopolitics comes back and threatens to reignite the entire cycle. If oil sustains above $90, inflation expectations reset. If inflation expectations reset, the Fed loses control of the narrative. If the Fed loses control of the narrative, the bond market decides what happens next. Now look at what's happening in Europe. Natural gas prices spiked 20%. Why? Because Europe is still fragile. They're still dependent on energy imports. They're still one supply shock away from another crisis. And if the US and Iran move toward open conflict, Europe gets caught in the crossfire. Sanctions tighten. Energy routes get disrupted. LNG shipments get redirected. And European industry, already on life support, takes another hit. But here's what nobody's saying out loud. This crisis is convenient. It's convenient for the United States. It's convenient for the defense industry. It's convenient for an administration that needs to unify the country around an external threat. It's convenient for a Federal Reserve that needs an excuse if inflation comes back. It's convenient for an oil industry that benefits from higher prices. You start to see the incentives and you start to ask yourself, who actually wants de-escalation? Let me take you deeper. Iran has been building shadow financial infrastructure for years. They've been locked out of SWIFT. They've been sanctioned into isolation. But isolation breeds innovation. They've developed barter systems with trading partners. They've used cryptocurrency channels. They've routed payments through shell companies in Dubai, Turkey, and Hong Kong. They've essentially created a parallel financial system that exists outside Washington's control. And now, as tensions rise, that system gets stress tested. If the US moves toward military action, Iran doesn't just respond militarily. They respond economically. They flood the market with subsidized oil through back channels. They disrupt shipping routes. They activate cyber capabilities targeting financial infrastructure. They turn the Strait of Hormuz into a choke point, not by closing it, but by making insurance costs so high that tankers reroute. This is asymmetric warfare. This is how a smaller power punches above its weight. And the market knows it. That's why the volatility isn't just in oil. It's in shipping stocks. It's in insurance derivatives. It's in currency swaps. The entire risk architecture of global trade is being repriced in real time. Now connect this to what China is doing. China gets 40% of its oil from the Middle East. A conflict in the Gulf is a direct threat to Chinese energy security. So what does China do? They accelerate their strategic petroleum reserve buildup. They lock in long-term contracts with Russia and Central Asia. They push harder on renewables and nuclear. And they weaponize their treasury holdings as leverage. Here's the game. If the US escalates with Iran, China has options. They can dump treasuries and spike US borrowing costs. They can offer Iran financial support through yuan liquidity lines. They can position themselves as the diplomatic solution while the US looks like the aggressor. It's a geopolitical chess match, and energy is the board. And don't think this is abstract. Look at what just happened in the copper market. Prices jumped. Why? Because if conflict disrupts Middle Eastern supply chains, manufacturing slows. If manufacturing slows, demand for industrial metals should drop. But copper went up. That tells you someone is front-running a different scenario. Someone thinks this conflict accelerates the move away from oil dependency. Someone thinks this accelerates electrification, green infrastructure, and the entire energy transition. And copper is the metal you need for all of it. Let me show you the trap. The United States wants to project strength. It wants to deter Iranian aggression. It wants to reassure allies in the Gulf. But every show of force increases the risk of miscalculation. Every military movement raises the probability of an incident that spirals out of control. And the market is watching. The market is pricing in that probability. The market is saying, this doesn't end cleanly. Look at the defense contractors. Lockheed, Raytheon, Northrop Grumman. They're up 8 to 12% in a week. That's not speculation. That's the market pricing and increased military spending, extended deployments, and replenishment orders. The defense sector doesn't rally like this unless the contracts are coming. And here's the darker layer. Wars are inflationary. They consume resources, they redirect production, they create supply bottlenecks, they force governments to spend without regard for deficits. If the US enters a prolonged conflict with Iran, you're looking at years of elevated defense spending, oil price floors above $70, and a Fed that can't cut rates because inflation stays sticky. That scenario breaks the everything bubble. It breaks the assumption that rates come down and risk assets rally. Instead, you get stagflation, rising costs, and slowing growth. A market that can't find a bid because there's no safe assumption left. Now look at gold. It didn't just go up, it broke out. It took out the previous all-time high and kept going. That's not a hedge. That's a vote of no confidence. That's the market saying, we don't trust the dollar. We don't trust treasuries. We don't trust the Fed to manage this. Gold is the ultimate political metal. It moves when trust breaks, and right now it's moving. But here's the twist. Gold isn't the only thing moving. Silver is starting to catch a bid. Platinum is waking up. The entire precious metals complex is starting to price in a world where fiat currency management becomes a political variable, not an economic constant. When the Middle East destabilizes, it's not just about oil, it's about what backs the system. And if the system is backed by military force instead of economic trust, the metals start to reprice everything. Let me connect the final pieces. Iran knows it can't win a conventional war, so it fights in the gray zone. Cyber attacks, proxy militias, shipping disruptions, attacks on Gulf infrastructure that are deniable but effective. The US responds with sanctions, asset freezes, and financial isolation. But here's the problem. Financial isolation only works if the world is dependent on your financial system. And increasingly, parts of the world aren't. Think about what that means practically. 5 years ago, if you were cut off from SWIFT, you were cut off from global trade. Today, Iran processes billions in oil sales without touching a single Western bank. Venezuela does the same. Russia built its own payment system and linked it to China's. The financial weapon is losing its edge because the target's adapted. And here's what makes this dangerous. When economic warfare stops working, the pressure builds toward kinetic warfare. If sanctions can't change behavior, what's next? If asset freezes don't deter, what does? The escalation ladder gets shorter, the off-ramps disappear, and you end up in scenarios where miscalculation becomes catastrophe because there's no middle ground left. Look at the insurance market. This is where the hidden costs show up. Lloyd's of London just repriced war risk premiums for the entire Persian Gulf. Shipping insurance for tankers transiting the Strait of Hormuz doubled. That cost gets passed through the supply chain. It shows up in fuel prices, shipping rates, and ultimately consumer inflation. The war hasn't started, but you're already paying for it. Now watch what happens to global supply chains. Companies have spent 3 years trying to diversify away from China. They move production to Vietnam, Mexico, India. But those supply chains still depend on stable energy costs and open shipping lanes. A Middle East conflict doesn't just threaten oil, it threatens the entire logistics network that global manufacturing depends on. You get container ships rerouting around Africa instead of through Suez. You get air freight costs spiking because planes avoid Iranian airspace. You get just-in-time inventory systems breaking because transit times become unpredictable. And every broken supply chain is another input cost increase that feeds back into inflation. Here's the layer most people miss. This crisis is accelerating technological decoupling. China has been watching what happened to Russia. They've seen how the West weaponizes financial infrastructure, payment systems, even semiconductor supply. And they're drawing conclusions. If the US can do this to Russia over Ukraine and to Iran over nuclear programs, what stops them from doing it to China over Taiwan? So China accelerates self-sufficiency. They push harder on domestic chip manufacturing. They build redundant payment systems. They stockpile critical materials. They create economic fortresses that can withstand sanctions. And every step toward autarky is a step away from the integrated global economy that kept costs low for 30 years. This is the real cost of weaponizing interdependence. You force everyone to build walls. You force everyone to prioritize security over efficiency. And you end up with a fragmented world where everything costs more because nobody trusts the system. Russia survived sanctions by pivoting east. Iran is doing the same. They're trading oil for goods. They're using gold as settlement. They're building payment systems that don't touch New York. And every time the US weaponizes the dollar, it accelerates that shift. Every sanction is a reason for someone else to build an alternative. You're watching the architecture change. You're watching the moment when the global financial system stops being unipolar and starts becoming multipolar. And that transition is violent. It doesn't happen smoothly. It happens through crises like this one. It happens when the old system tries to enforce its rules and discovers it no longer has full compliance. The market gets this. That's why volatility isn't calming down. That's why every headline about de-escalation gets sold. The market doesn't believe in de-escalation anymore. It believes in managed conflict. It believes in a new normal, where the US and its adversaries are locked in permanent competition. The flashpoints just rotate. So what happens next? If diplomacy fails and this escalates, oil goes to 100. Treasuries sell off further. The Fed holds rates higher for longer. Inflation expectations re-anchor at 3% instead of 2%. Stocks reprice for a lower multiple environment. And gold continues its march toward $3,000 an ounce. If diplomacy succeeds and tensions ease, you get a temporary relief rally. But the structural issues don't go away. The Gulf states still don't trust Washington the way they used to. China still wants to reduce dollar dependency. Iran still has no incentive to cooperate. The next crisis is already being prepared. This isn't about predicting what happens tomorrow. This is about recognizing what's already happening beneath the surface. The global order is being stress tested. The financial system is being repriced. And the markets are telling you, in real time, that the old assumptions don't hold anymore. Stay alert.